So the obvious alternative is get or consider a reverse mortgage. And what I mean by that is a reverse mortgage, unlike a traditional HELOC, its line of credit, because a reverse mortgage can include, and I would argue the best way to access your equity with a reverse mortgage is set up a line of credit. Well, unlike a traditional HELOC, a reverse mortgage line of credit, a couple things about it. One is after you close the loan and you pay any mandatory obligations with the reverse mortgage, like if there is an existing mortgage, or even if not, just covering the closing costs, and maybe you've got upcoming property tax installment or homeowners insurance renewal. After covering those mandatory obligations to close the loan, you can set up, if you don't need any more of that money available, you can set up all the rest as a line of credit. And it can sit there unused and the lender's okay with it. But even better, the biggest benefit of the line of credit with a reverse mortgage is it grows over time. And that growth of the line of the unpaid balance of the line of credit, that growth rate is tied to the interest rate on the loan. Now,
wait a minute. So what you're saying is, if I take out, let's just say $100,000, but my total amount might be $200,000, that extra $100,000 could actually grow if I don't use it?
Right. When you get a reverse mortgage, and again, the most common one we originate are HECMs, Home Equity Conversion Mortgage, FHA product. When you apply for it, you do have to pay certain things at closing. And if you don't have an existing mortgage, it's pretty limited. It's closing costs and any property-related expenses that are coming up for renewal, like taxes or insurance. After you've covered those, and if you don't need any other money initially at closing, you can have the rest of the money set up as a line of credit. And the lender doesn't force you to take any of that line of credit available at closing. You can just set it up and leave it there. And then the additional benefit, unlike a traditional HELOC, is let's say you do that approach and you've got this $100,000 line of credit that's now in place and you don't need it. It's got a zero balance. Well, over time, that credit limit, 100,000 limit, is going to go up. And the amount of increase is going to be tied to what the rate is on the loan. And right now, reverse mortgage is the most popular one. The rates on those is right around the mid sixes. So what you're going to be looking at is a line of credit over time, at least based on current rates, growing at about a 6% plus per year. So suddenly that 100,000 the first year, now the second year it's 106,000. And then the third year it's going to be over 110, probably somewhere in the 113, 15 range, and so forth. So if you did get it as a rainy day fund, the additional benefit is no forcing you to start using it. It can sit there and then it grows over time. So if you have you're going to have access to more money over time because it's growing based on the fact that it's not currently got any money owed on it. So that is a great benefit on the HECM reverse mortgage line of credits that you do not see on a traditional HELOC.